Hi and welcome to the Capital Spreads weekly video. I'm once again joined by Bill Hubard, Chief Economist of Markets.com. Welcome, Bill.
Thank you.
And this week we are going to discuss the fact that not long ago, just a couple of weeks ago, the ECB announced their OMT, which was their sort of newest quantitative easing programme to alleviate bond yields in the periphery and for the likes of Spain and Italy. That seemed to be taken very well by the market. Then the Federal Reserve followed, obviously, with their QE3, and the markets rallied. We thought, wow, we're going to hit new highs for the years, and certainly the US markets did. But a week on, or 10 days on, we've wiped out those gains now. Why have the markets reacted so badly?
Well, I think, and I know these aren't market terms, as you mentioned, the ECB and the Fed, it was wish, hope, pray. The market felt that finally the central banks or the banking industry had taken over what needed to be done. But as you just said, in the last 7 to 10 days, it's the socio-political situation again. Riotings in Athens, problems in Spain. And again, waiting this afternoon to see how Spain is going to reduce their budget by 18 billion euros at a time of extreme austerity.
Yeah, well, I mean, obviously Spain is the key point at the moment, and we're probably by the time this goes onto the website, I should imagine that it will become clear what budget and austerity measures Spain will want to put forward for 2013. Now, the market is obviously thinking that these measures are to ensure that the EU creditor nations are happy in order to then give the green light to ECB bond buying. Do you think that that is what's likely to happen, and will that lead to more risk appetite?
Well, I think one of the points is that, and we had this from the Bundesbank this morning, saying that basically, whether it be Greece, Spain, he did mention Italy, the ECB cannot, and the Eurozone cannot be a stopgap method, okay? This has to be done. The methods have to be fully justified, fully voted on, and fully agreed upon by the respective nations. And this is extremely an important point. And I think one of the things that maybe some of our viewers may not have noticed is last week, Catalonia, which is the most profitable province or state in Spain, basically submitted a referendum, quote, to secede. Now, it's gone from secession to sovereignty, but I think one of the things that people have to look at is that, this problem with Catalonia basically making the money in Madrid, spending the money, has gone on since about the 1720s, and it really reached its zenith during the Franco regime, when Catalonia, which is the language of Barcelona, was disallowed. One of the things I think you have to look at, the importance of this is, if Barcelona were an independent country, it would have a GDP greater than Austria. It'd be like California saying, thanks boys, we'd like to be our own country and secede from the US. And I think this is going to be extremely important, in how it's worded, and if Catalonia, quote, accepts, because one thing they want is, quote, more sovereignty in how the government spends.
Well, it's worrying, isn't it? Because I suppose that it shows that obviously the whole Eurozone project is splitting potentially, and extremities are coming in, and people want their own autonomous regions. So it'll be very interesting to see how that pans out. The other concern I just wanted to touch on, I suppose it's rehashing the same old stories, Spain and Greece, but Greece is a worry. They have some 330 billion euros of debt. It's a vast mountain for such a small country in terms of its economy. Do you think that we will see more haircuts to those outstanding debts taken on by the private investors?
Well, I think that, and also a clarification of the European Central Bank in whether they, quote, as you mentioned, take haircuts, will they sterilize the investments? And fortunately, if nothing else, at least the verbiage from Super Mario has seen Spanish yields dramatically fall, although the 10-year is still around the 6% level. Italy today had a very, very good bond auction, and the rates are starting to fall. But as you just mentioned, the two problems there are, and I'm not trying to diffuse Greece, but the problem is what will happen. And hopefully, as you say, in the next hour or so, we will find more clarification. But again, I've said this over and over. I have a very difficult time, in these times where you've got corporations not making any money. In Spain, you've got the legitimate unemployment rate of, quote, 25%. So individuals aren't making any money. So where is the money coming to the Treasury? Okay, the only way they're going to be able to do it is fund it. And as we saw today, unemployment in France now hit the 3 million level, highest in 13 years. And remember, tomorrow, on Friday, we're looking at probably the most austere budget presented to the French people in 30 years.
Yeah. So things are looking difficult still,
yes.
no matter what those central banks seem to do. Just let's finish off on what that means for the euro itself. What are your targets? I remember when we first started these videos, that your view at the time was when the euro dollar was really crashing, went below 1.2, that you had a target for 115 at year end.
Now, I will have to say, being a trader, once we didn't take out the 120, we got back to that technical level of 124.88. I advised clients to go long. We went long anywhere up to about 131, 131.50. My feeling is right now, I'm net short. If we look at the economic statistics between now and the year and next year, I'm in about the 118 level for this time next year.
Lovely. Thanks a lot, Bill, and thank you as ever. That's it for this week.